Yesterday was alarming not only for US stock markets. The real hidden turbulence unfolded in Asia, especially in Japan, where events moved so quickly that many analysts now call the situation on the Tokyo Stock Exchange the first jolt that sent a wave of instability across global markets. The morning rally, Nikkei stability, and positive reports from major Japanese corporations should have offered support to investors searching for a solid foothold amid the chaos in the US, but things turned out differently. According to Financial Times, the Japanese market went through its most nervous day in months. Despite an early Nikkei rise of almost plus 3%, driven by a weak yen, by midday tension dominated the market, and by the close, it became clear that deep structural fractures were hiding beneath the surface. The problems began in the currency market. The yen came under heavy pressure again, approaching the historically dangerous level of 158 yen per dollar. This threshold, which alarms the Bank of Japan, became a symbol of the country's financial foundation, cracking under global pressures. Market Pulse reports that in the first hours of trading, several emergency consultations took place between the Ministry of Finance and the Bank of Japan because concerns about a possible currency intervention were rising so quickly. At the same time, panic erupted in the bond market. Yields on Japanese 10-year government bonds jumped to levels unseen for years. FT writes that this triggered a massive cold shock among international investors who suddenly saw the threat that Japan's debt market, one of the most stable in the world, was starting to lose its footing. The weak yen gave temporary support to exporters, and many traders initially interpreted this as a positive sign for the Nikkei. This is why the index climbed early in the session and some tech companies received a short-term boost. But as Nasdaq.com later wrote, this rise was empty and illusory because underneath it lay a far more dangerous foundation. Capital began to exit Japanese government bonds, a level 1 alarm signal in the global financial system. Insiders at Japanese banks told Bloomberg Tokyo openly that they were seeing the first signs of trust in Japanese debt beginning to erode, and if this process continues, markets will fall much faster than anyone expects. This Japanese chaos did not remain a local issue. It became a hidden catalyst for yesterday's downturn on Wall Street. Japanese funds and global investors, who traditionally use Japanese bonds as a safe haven, were forced to rapidly reconfigure their portfolios. A flight to the dollar began, and thousands of hedging operations were triggered automatically. This caused large capital flows that usually remain within Asia to move rapidly into the US in the form of dollar liquidity, but not into the stock market, into cash. And instead of supporting US equities, this liquidity worked in the opposite direction. Funds began closing positions in risky assets, including tech stocks, becoming one of the hidden triggers of the US market's sharp reversal from morning gains to evening losses. Why did this happen now? Why did Japan, a country with the largest public debt in the world and a unique monetary policy, suddenly end up at the epicenter? The answer lies in geopolitics and in the actions of Donald Trump. In recent weeks, Trump has been increasing pressure on Japan to revise trade agreements, boost purchases of American weapons, change import quotas for agricultural products, and effectively align its policy with the new trade configuration the White House wants to impose on Asia. According to Japan Times, Trump reportedly said at a closed briefing that Japan must do more, adding that the US has protected Japan for decades, and now it is Japan's turn to protect the US economy. These words were interpreted in Tokyo as direct pressure. Far more serious, however, is that Trump is discussing a new package of tariffs that could hit the Japanese auto industry, the heart of Japan's economy. Nikkei Asia writes that Japanese officials are already warning that such a move could trigger a chain reaction inside the country's financial system, because export companies are key holders of debt instruments and major clients of the banking sector. If the auto industry comes under attack, it will affect not only corporations, but also prefectural budgets, bank balance sheets, pension funds, and the currency market. The tariff threat hangs over the market like a cold shadow, and yesterday investors finally assessed it for what it is. This geopolitical uncertainty became the trigger for a larger process. Japanese markets stopped being a safe zone, and when Japan stops being an island of stability, the whole world feels it. Falling confidence in Japanese debt automatically raises borrowing costs worldwide, and yen volatility increases risks for global funds. This is why yesterday's correction in the US was not merely an internal issue. It was a reflection of a collapse of confidence that began in Asia. Analysts now say the Japanese market may become the next crisis zone. Morgan Stanley Tokyo writes in its morning report that Japan is entering a phase of systemic risk, and if the yen moves beyond 160 and bond yields continue rising, the financial system may face a domino effect. Such a statement is rare for the Japanese segment, which usually sinks in stability, but now that stability is disappearing. The morning spike and later decline of the Nikkei was not noise but an early symptom. Economists warn that if Trump continues to increase pressure on Tokyo, if trade threats become reality, if the Bank of Japan cannot maintain balance between inflation, currency, and debt, the Japanese market may enter a full-scale crisis. This is not an exaggeration. Japan is a financial node on which a massive volume of global capital depends, and if this node weakens, the wave will hit not only the US, but also Europe, China, and Southeast Asia. Yesterday's correction may be only the first signal that this node is beginning to strain. Watching Japanese bonds fall, the yen weaken, and the stock market surge in the morning only to sink by evening, many investors felt this was not just a day of volatility. This is the beginning of a more dangerous period, one in which Japan may shift from a stable giant to the epicenter of a new financial earthquake. And if Trump continues changing the rules of the game, this process may accelerate. The most alarming developments are beginning now, after all markets have closed. The night following the Japanese session brought new data that only heightened analysts' fears. According to Tokyo Commodity Exchange, hedging volumes for currency risks nearly doubled, a move that happens only when major corporations prepare for prolonged turbulence. Japan's megabanks, Mitsubishi UFJ, Mizuho, Sumitomo, began regrouping currency positions, shifting part of their resources into ultra-short instruments typically used in periods of expected instability. These are not ordinary measures. Such steps indicate that banks are preparing for severe fluctuations that could affect all key areas of the economy simultaneously, from industrial exports to domestic consumption. Japan Times reports that the Ministry of Finance is seriously discussing a scenario in which the country could face a double shock, a falling yen and rising bond yields at the same time. This combination is considered a nightmare scenario in economic terms because it tightens both external and internal liquidity. For Japanese corporations, it means more expensive borrowing, for pension funds, potential losses, for government programs, reduced maneuvering space. If this scenario materializes, yesterday's Nikkei drop may look like just a prelude to far larger movements. Meanwhile, Washington, seemingly unaware of how fragile the Japanese market has become, continues to pressure its allies. Insider documents published by Politico Asia indicate that the Trump administration is considering including Japan in an expanded list of countries subject to tightened export restrictions in high-tech sectors. This has already sparked panic in the domestic market. Japanese companies realize that access to American technologies and components is fundamental to their competitiveness. If access is restricted, it will hit the entire production chain, from electronics to the automotive sector. Yesterday's surge and subsequent Nikkei drop was merely a reaction to the first rumors. What will happen if the restrictions actually come into force?